You are listening to the Wealth Formula Podcast with Buck Joffrey. Get ready to change your life.
Welcome, everybody. This is Buck Joffrey with the Wealth Formula Podcast, coming to you from Montecito, California. Today, before we begin, just a quick reminder, there's lots of stuff for you on wealthformula.com, the website associated with this podcast. Lots of things to download and enhance your experience. There's also some email lists you may want to join, including the Accredited Investor Club. Some interesting things coming down the line there. So if you're an accredited investor or interested in seeing some deal flow, certainly sign up and get onboarded if you are an accredited investor. Now, this week, I am going to talk about an interesting concept that seems to happen within governments in general. It's sort of the natural history of what happens over time. You know, government's a funny thing. It's an organization that makes and enforces rules and regulations. And the more rules and regulations it makes, the bigger it gets, right? It's a monster. It's a bureaucracy, and it just, thrives on making itself bigger and more rules and more committees. And in that process, the government also becomes a significant employer, a huge employer. And the problem with this employer, he doesn't really care about being lean and profitable. Just wants to get bigger and bigger. And it doesn't really matter how much things cost, right? Because the bottom line doesn't matter. It's more about creating more things to control. But as the government starts to infringe on people's perceived personal space, people start to push back. And that is really the only force that resists this monster's thirst for power. Now, don't get me wrong. It's not all people want to resist that power. Some people would rather just, go all in, have government control of everything. But I think for the majority of people, there is a resistance that pushes back and keeps things from getting out of control. Now, make no mistake, during these times when governments are held in check by the majority of the people, the monster's appetite for power and growth, it really doesn't go away. It just lurks in the background, waiting for its opportunity to pounce. And that opportunity comes up periodically. It's when things get bad, when people are at their most vulnerable, these times of crises. I don't know if that crisis or crises, I don't know what the plural of crises. When things go south, here's the thing. When things go south, people are willing to give up more of their freedoms in exchange for stability. Just think about that, right? I mean, it makes sense. Governments are more than happy to oblige there. And if you want to think about how this applies to some of the more recent events in our history, just think about the terrorist attack of 9/11. Think about the 2008 financial crisis, COVID, even to a certain extent, the Silicon Bank failure. In each situation, the government found an opportunity basically to change the rules and, obtain ultimately more control. This playbook, by the way, and I'm not really a conspiracy guy. All right? I'm just not. I know there's a lot of people in this space who are. And this isn't really a conspiracy theory. It's just how things work. It's the economics of big government. It's like big government begets big government. Mainstream figures will tell you the same, and you'll find out this week on this week's Wealth Formula Podcast how that works from a couple of guys who used to work for the government. We'll have that interview when we come back from these messages. Welcome back to the show, everyone. Today, my guest on Wealth Formula Podcast are Alex Pollock and Howard Adler. Now, this is they have a book called Surprised Again, The COVID Crisis and the New Market Bubble. Both Alex and Howard are, they're guys who worked for the Treasury, which is, pretty mainstream. And of course, the concepts that they talk about in their book will be of surprise to a number of you. Let me give you a little background on Alex Pollock first. He's a senior fellow of the Mises Institute and the author of Finance and Philosophy, Why We're Always Surprised. Notably, it's surprised again this time, right? And Boom and Bust, Financial Cycles and Human Prosperity. He was a principal director of the Office of Financial Research, U.S. Treasury, from November 19th to February of 21. There was a lot more to say about him, but I want to get to Howard, who's also an attorney and former government official who from May 2019 to January 21 served as the Deputy Assistant Secretary of the Treasury for for the Financial Stability Oversight Council, where he was responsible for monitoring the financial stability of the United States during the first year of the COVID-19 crisis. He's very distinguished, been awarded the Treasury's Distinguished Service Award for his efforts by the Secretary of Treasury as well. Long introduction for you guys. You know, you're too accomplished for the show, unfortunately, and we don't have time for anything else now.
This says former surgeon turned star investor.
Well, something like that. But welcome to the show, guys. This is a fascinating topic. First of all, you know, speaking about this book and the concepts, I think you talk about a U.S. experience in boom and bust financial cycles every 10 years. How does that happen? I mean, do you want to talk a little bit about that?
Historically, it is just the case that more or less, not exactly, but more or less, about every 10 years, we have some kind of financial crisis. Paul Volcker had a very witty comment on this. He said, every 10 years, we have the greatest crisis in 50 years. and that's a comment that's particularly insightful because memories are short and institutional memories are short. New people come in, old ones' memories get fuzzy.
Yeah.
For example, one of the decades both Howard and I lived through was the 1980s. In the 1980s, 1,000 savings and loans in this country failed, and 1,400 commercial banks failed. People just don't remember this.
Sure.
These financial structures can be very fragile when faced with what they didn't expect. And often enough, things that weren't expected or even thought impossible do happen. Anyway, the physicist Freeman Dyson said, many things which were considered impossible nevertheless came to pass.
Sure.
And he's so right. And examples would include house prices falling on a national basis, which was thought to be impossible. That was early 2000s. Oil prices dropping precipitously in the early 1980s, which was thought to be impossible. Big, important banks going bust. And more recently, interest rates rising rapidly after everybody had gotten used to the idea that interest rates will be lower for longer. So this is a long history, over history, different things at different times. But the great financial historian Charles Kindleberger, from whom I learned this 10-year, more or less, cycle, he observed it over several centuries. In the 19th century, when Walter Bagehot, of whom we'll speak later, was writing, he was observing a 10-year cycle in England in financial crises, and we still have it now. So we've had crises in the 80s, 1980s, 1990s, 2000s, 2010s, and now 2020s, and here we go.
So is the idea there that it's just the natural history of the economy, or is there a sense that there is a that sometimes the government actually creates these problems?
Oh, no question that the government contributes to creating these problems. We saw it, well, in the 1980s with the collapse of the savings and loans, which was from the same thing Silicon Valley Bank collapsed from, namely having short-term deposits invested in very long-term fixed-rate assets. That structure of the savings and loan balance sheets was mandated by the government. They were forced to do that by the regulation. In the great housing crisis, the government was the leader in trying to create what they called innovative, but which meant low-quality mortgages, which of course unraveled. And now we have a long period of the Federal Reserve, I say, being the Pied Piper for believing in very low interest rates, and it was going to be safe to hold fixed rate assets against it. And now we see the opposite is the case. So the government is absolutely involved in helping to create these, as well as trying to get out of them once we're in them.
Yeah.
And of course, when Ben Bernanke in 2008 began his so-called quantitative easing, which involved buying mortgage-backed securities up to the tune of about ultimately $2.7 trillion worth, thus making the Fed really the largest savings and loan in the country, and certainly providing unnatural, if you will, artificial support to the housing market, creating a housing bubble that we've now got. Now that quantitative easing is going to end, is winding down, one can speculate what's going to happen long term to the housing market without that crutch. But it's not only the government; it's also human psychology. When the markets are going well, people don't want to miss out on a good thing, and they keep buying. And people tend to have collective amnesia; they forget that things can go down, and then they're reminded there's a crash, and then they miraculously forget again. It's sort of what I noticed as a young lawyer when I was doing sovereign debt deals in Latin America. Everyone talked about the prospects of Latin America, what a great place it would be for future growth, and then they default, and then a couple of years later, we'd be talking about prospects again, and people would forget about the defaults until the next default.
Yeah,
it's also human psychology.
Yeah.
And remember, on Howard's very accurate point, that while the bubble is on, lots of people are making money.
Right. And that brings me to the next question, which is one of your arguments is that government agencies, the Fed, everyone involved in control always tends to use these moments of shock, in the boom and bust cycles to gain power. Is that right?
I think you've got it exactly right. For example, the Silicon Valley bank failure and the Signature Bank failure just a few weeks ago is a perfect example of that. Now there are calls for tighter regulation, more regulators, more authority to the Fed and other bank regulators, and yet at least Silicon Valley Bank failed because of the most basic thing in banking, managing your interest rate duration. This is something that you learn if you're a young banker in your first day of training. This is something you learn in the first week. That the safest thing to do is match the duration of your assets and liabilities, and if there's a mismatch, then you're going to be either vulnerable to a rise or a decrease in interest rates, depending on which side the mismatch is. And there are 15 pages in the Federal Reserve Bank Examiner's Manual on this point. The authority, and examiners called it out. The authority was there to fix this, and yet the supervisors failed to do it. And now they're going to impose new regulations, which aren't needed, at least to solve that problem.
Right. So basically, it's I guess part of the, what this argument sort of reminds me too is, I don't know if you recall this book, it was in 2007, it was Naomi Klein, The Shock Doctrine. Does that ring a bell at all? Anyway, similar concept where basically the idea was that, every time there was a major, economic problem or any kind of disaster really, that created shock, that there was an opportunity to create further control, further regulation, and usurp power because people aren't paying attention to, anything but survival at that point. That's kind of the
crisis tends to centralize power,
right,
and then it tends never to go back to where it was before. There is a classic book on this, which you may know, "Crisis and Leviathan" is the name of it. Mm-hmm. By Robert Higgs, which makes exactly this argument, I think, very brilliantly. There's a constant ratcheting up of the power of the state with each crisis, and then it might back off a little bit, but it never goes back, and then it ratchets up again. And we certainly see this in the financial system.
How did this? I know, when you mentioned the bank crises, it sounds like there was the current bank crises, these little small banks, that essentially these were oversight issues internally, right?
Management, you can call it. fundamental management mistakes.
Fundamental management mistakes. But then I guess the question is, what is the role of government in that? And is the government at fault in this? I guess, to your point initially about how these cycles are really almost planned out, so to speak.
No, not planned out. I don't think so.
Yeah.
But they do happen with some regularity, which is fascinating.
Yeah. Okay. Sounds good. And let me ask you this. So you mentioned political finance. You said all finance is political finance. You want to talk about that?
Well, it's all political. The Secretary of the Treasury is essentially a political figure. The Chairman Powell, the Board of Governors of the Federal Reserve System, supposedly the Fed is supposedly above politics, but nonetheless, I would submit that any senior official who gets appointed by an elected official is by his or her very own nature political.
Sure.
And politics factors very heavily into this. One of the things we have to watch out for, and you talk about government power, and I just want to tie those two themes together for a minute, is that now you're starting to see, well, gee, if deposits are not safe, the deposits that aren't federally insured in the banking system above $250,000, maybe we should go to a central bank digital currency, a Fed money, where in essence, your bank is the government. So since all of your money would be guaranteed by the government, then your deposits would be safe. And you're starting to see smart people make that argument. But that is a very dangerous situation because it would give enormous power to the central bank. If that were to happen, you might not have a private banking system.
We think it's the worst financial idea of current times.
Right.
The central bank digital currency.
Just starting from an economic point of view, the banking system employs about 2.5 million people. If they were out of work, that would have a terrible impact on the economy. Banks are the main tenant of many commercial office buildings. That would have a horrible impact on the real estate market. And if all of these deposits were on the books of the government, they would have to have assets to balance these deposits, which would mean that the government would get to pick who gets money lent to them and who doesn't. And obviously, you can see that in some administrations, that would mean no oil and gas companies got money, and you would have politics going into the private, what has up to now been a private credit allocation crisis. And we, not to mention the fact that the government could look at every financial transaction that every individual in the country had, and we think it would have disastrous consequences for the economy and for people's freedom and privacy.
This is an interesting concept because there's multiple problems with it. You mentioned privacy, the ability of the government to see all transactions, that kind of thing. But I get different stories on what the purpose of the central bank decentralized process would be all about. I mean, some people argue that, listen, all these dollars are all digital anyway. All they're doing is turning it in, using a different, more efficient software. But you see it as more of an elimination of the banks type situation.
We see it as a colossal centralization of power.
Yeah.
Over people, individuals, and over institutions in the country. In our judgment, extremely dangerous and a really truly bad idea.
Do you think there's a political? First of all, you have the banking industry, which is probably not going to be real happy about this, and they've got some fairly powerful lobbyists, I imagine. For being big banks. I mean, how realistic, from a political standpoint, do you think that this kind of change would actually be?
Well, it depends on what happens. If two medium-sized banks like SVB and Signature failed, no. But if there are massive bank failures and people start worrying about the health of the banking system and people are at risk and the market crashes and you have a huge failure of confidence in banks, then I think, a lot of bad policy is made as a result of crises. Then you may see a lot of people hailing this sort of thing as a panacea, and people maybe not prone to listen to the banks that, after all, would be the ones who are perceived to have gotten us into all this trouble.
Is there anything that would make you concerned that the larger banks may have a similar problems going forward?
I think the larger banks are, first of all, I think most of them are pretty well run. They have embedded. This is an easy problem to fix. I mean, there are interest rate hedges available that people could just have bought insurance against this sort of problem, or you could have simply matched the duration more closely of your assets and liabilities. And the Fed has made it easy now for people with this problem to get out of it by basically opening up a credit line that will lend 100% of your collateral, assuming it's government and mortgage bonds, even though that the market value of that collateral may be far less, which is a great deal.
However, to be noted. Could I just jump in there, Howard?
Yeah, sure.
To be noted, on that credit facility, the losses from such a facility will be taken by the Treasury. That is to say, the taxpayers. The Fed will lend you the money, but the junior partner in the deal are the taxpayers.
Right.
But most importantly, what we learned from 2007 and 2008 are that these big banks are completely safe because the government will not cannot allow them to fail. If JP Morgan or Citi or Bank of America failed, their counterparties who would be exposed, there's so many tentacles in every aspect of our financial system and our economy that their failure could simply not be allowed to happen.
Sure.
Dodd-Frank was supposed to cure the too big to fail problem, but of course it didn't. And that's what you see now. You see a flight to safety, people taking their money out of the mid-sized and regional and smaller banks and putting them in the so-called GSIBs, the very largest banks.
Yeah, it is the case, however, that very big banks can get into a lot of trouble. Big organizations have failed. Big banks have had to be bailed out. The term "too big to fail," I think, was invented in 1984 for the bailout of Continental Illinois, which seemed like a big failure at the time. It's been since surpassed many times. But big organizations can get in trouble. They do have this implicit support, which is very real. Another good example of that would be Fannie Mae and Freddie Mac, both of which became insolvent and were bailed out at great taxpayer cost. However, I think we have to say, among the risks we have, I mentioned a minute ago the Federal Reserve as Pied Piper banking system. Among the risks is that in the banking system as a whole, there is a very large mismatch between long-term fixed rate assets and on net, the short-term floating rate deposits, which are financing them. A huge mismatch. Now, the data is challenging here, but there have been two studies recently. One estimated that the mark-to-market unrealized loss on the whole banking system, and this counts both bonds and loans. One estimated $1.7 trillion mark-to-market loss for the banking system, and the other estimated $2 trillion mark-to-market loss for the whole banking system. Now, the banking system as a whole has $2.2 trillion in capital and equity. Of that $2.2 trillion, $400 billion, however, is goodwill and other intangibles. So the tangible equity is about 1.8 trillion. Now, what does that mean exactly? If you have a mark-to-market loss that's more or less equal to the mark-to-market capital.
Yeah.
To the tangible capital, which would, to get to the mark-to-market capital, you subtract the loss from the capital. Well, we're going to find out, but there is definitely system-wide theme here. Decisions made by managements, but very much induced by the long period of suppression of both short and long-term rates by the Federal Reserve. And that's something we need to keep our eye on. And now we've been surprised yet again, as we said, by these couple of bank failures. And then we'll see how the rest of this plays out. Depends a lot on how interest rates play out. Now, in the 80s, interest rates were pushed into double digits with disastrous consequences. For banks here, we have short-term interest rates around 5%, which people say is high, but it's not high. Historically, 5% is an average kind of interest rate, but it's already causing some certainly important strains.
What do you think from your perspective as former Treasury people? How do you look at the way things are being managed by the Treasury Department and by the Fed right now?
We've both, if you've read any of the stuff we've written lately, we've both been rather critical of that management. We talk about the COVID crisis, which in a crisis, Alex alluded to Walter Bagehot, who was a 19th century British banker and a great writer, really wrote the book on what you do when you have a financial crisis. And the book is you lend freely to companies of good quality at high interest rates and on good collateral. And the COVID crisis was a different kind of crisis. It wasn't due to the inflation of an asset bubble or a lack of capital in banking or housing like the 2007-2008 crisis was. It was basically the whole economy shut down. We had a health crisis, and that led to political decisions, forced the economy to shut down. Small businesses were closing. Restaurants were closing. We had to get money out into the hands of people. We were facing an economic and a human catastrophe, and that's what we did. So we just lent freely. A lot of these loans were forgiven. We adopted part of Bagehot's plan, but not all of it. The problem with this is we are also followers in what in our book we call the Cincinnatian principle. Cincinnatus was a Roman general who, when Rome was invaded, was called out away from his farm given dictatorial powers and told to fix things. He defeated the enemy in 15 days, gave up his powers, and went back to his farm. The Cincinnatian principle says that when a crisis is over, you stop. But this administration didn't stop. I mean, the crisis was really over at the end of 2020, but we had massive additional spending. The 1.
And money printing.
And money printing, the 1.9 trillion American Rescue Plan, these proposals to forgive student loans, all of which cost massive amounts of money, and that's inflationary. There's a recent Federal Reserve study that if you ran the numbers down, attributed roughly 40% of the inflation that we've seen to government spending. And you can't do that without having an inflationary effect. And we think that had prudence and common sense reigned in 2021, and the spigots, financial spigots, were turned off, that we would not be in the kind of shape we are today with this massive rise in interest rates. We would have some inflation, but it wouldn't have been as bad as it is today. So we've been I think both critical of the economic policy that has been followed by the Biden administration.
If you believe that in a crisis, whatever the cause, it takes crisis actions, then this Cincinnatian doctrine, we think, is really important. You've got to turn off the interventions when the crisis is over. But it's hard to do that. It's hard to make it happen in our.
It's hard to take things away once you give them.
That's right. Everything you give creates a constituency for people who benefit from it. Now, a really searing example of this is the Fed's purchases of mortgages, which Howard mentioned before, in the form of mortgage-backed securities. in the face of an unbelievable house price inflation in this country, the Fed went right on stoking the housing market all the way to March 2022. It was amazing. And we said at the time, they have to just stop buying mortgages. But they didn't. They went right on in the face of a giant house price inflation. Well, now, among the prices we're paying is the correction of that mistake.
Going back to your comment, Howard, about money printing and excessive intervention. I wonder, I think a lot of people wonder the same thing. I mean, we obviously had a significant intervention after 2008 as well. It didn't lead to this kind of inflation. What's the difference?
Well, I think the difference is degree. What happened in 2008, 2007, and 2008 was what happens in every crisis. The Treasury borrows money, and the Federal Reserve prints up the money to buy the Treasury's debt. They work hand in hand. What you saw in 2007 and 2008 was an increase in the monetary supply and in the amount and the Fed's balance sheet from roughly 800 or 900 billion prior to that crisis to roughly 4 billion after.
4 trillion.
Trillion. That's right. 4 trillion after that crisis. And a trillion, as you know, is an enormous amount of money. It's 1,000 billion. It's hugely big bucks.
Yeah.
And you can't lose sight of that. And when you listen to these government things, you say, "Oh, it's just another trillion," but there's no such thing. So what happened was that when the Fed faced this crisis, its balance sheet had not come down very much. It was already dealing with about a $4 or $5 trillion balance sheet, and the spending in this crisis add another 5 trillion to that. You got up to about 8.9 trillion. That's a serious number, and it's a serious amount of increase in the monetary supply. So the problem with these crises is that you never really recover because the Fed doesn't want to sell the stuff that it bought, the debt that it bought. It does if it sold $2 trillion of commercial mortgage obligations, it would destroy the housing market. If it sold the 5.5 trillion of Treasury debt that it had, it would destroy the Treasury market. So
which markets were overpriced exactly because of the Fed buying. Right. So you got these tremendous tops in the markets, which were created by the Fed itself, being the big bid to buy at the very high prices. Could I just add one thing in there too? And that is that this wasn't only happening in the U.S. You had many other central banks all together and we treat this actually in a chapter in the book. We call central banking to the max, and we document how European Central Bank, Bank of England, Bank of Canada, Bank of Japan, Federal Reserve, they're all in this together. So you get an international multiplication with the result of first of all, a tremendous asset price inflation, which did already happen after the earlier interventions during the 20 teens, a tremendous inflation, but inflation in asset prices. That continued then beginning in late 2020, and we talk about that in the book. The second COVID surprise was the big asset bubbles, and then of course the consumer price inflation. But it's very interesting to see how this isn't just the Fed; it's all these central banks getting together and all doing that same. And there are some very striking graphs in the book to that effect.
What do you think? Where do you think this all ends, or not ends? But is there? It just seems like we're on the brink of something again, something big. And the question in my mind is always, at some point, do we end up with some kind of reset? Do you foresee that? I mean, I know there's people out there talking about. I don't even know if it's a legitimate economic philosophy, but this modern monetary theory, things like that. Where do you think this is? Where do you think this ends?
Well, modern monetary theory, I think this inflation, if nothing else, demonstrates what absolute nonsense modern monetary theory was. The idea that the government can borrow forever with no impact on interest rates and no adverse consequences. Well, look at the inflation that we're dealing with now. That wasn't the case. Well, I tell you what I worry about, and I wrote about it in a piece in the opinion piece in the Wall Street Journal in December. As I said, you never go back to zero. We're never going to go back to a Fed balance sheet of 800 or 900 billion, because each crisis is cumulative. You borrow more, you spend more, and the levels get higher. And what I worry about is we're very lucky because we live in a great country, and everyone wants United States Treasury debt because the dollar is the world's reserve currency. Foreign central banks keep their the bulk of their foreign reserves in dollars that create in the form of Treasury debt. That creates tremendous demand for Treasury debt. But it isn't infinite. Nothing's infinite in the world. There are only 8 billion people in the world. And, ultimately, we may borrow to a point where we can't borrow anymore. And that concerns me.
Howard, we have a two-part saying, and half of the nothing is infinite is Howard's part, and my part is, and nothing is free.
Right.
Whatever you do, you pay a price for.
And that's what modern monetary theory gets completely wrong. There is a cost to everything.
Again, the book is Surprised Again, the COVID Crisis and the New Market Bubble. Are we missing any major themes here that we haven't addressed on this that might be worthwhile bringing up?
We'll just stress one of the things that Surprised Again is a kind of meditation on the nature of uncertainty. Particularly in financial markets, and how if you have a dream that there's going to be some master, a central bank or a government or anybody, sitting aside and taking care of you and making sure that nothing goes wrong, that's a dream you'll wake up from, because we think, and we discuss in the book and use the 2020 panic as an example, but the examples come along, as we said, every 10 years or so, of the fundamental uncertainty, that is to say, unknowability of the financial future.
And the book goes on to take, number one, examines what happened during the COVID crisis, the tremendous shock to the financial system, the massive government intervention that led to a reinflation of all assets, and to the so-called everything bubble and the inflation we have now. And it talks about, as Alex said, the nature of financial uncertainty in particular, but also takes a look about certain sectors of the financial system, of the economy, if you will, that are likely to create trouble in the future. And those areas are that we look at include money market funds, cryptocurrency, student loan debacle, public pension plans, which are another huge problem. And so we try to look at weaknesses from
housing. You didn't mention real estate and housing, but yeah.
Real estate and housing, and finally, just the role of central banks in general. So we think that it not only looks at the past, but it is a good view into the future. And some of the stuff that we said, we wrote the book, finished it almost about a year ago, a little more than a year ago. And some of the stuff, when I read the editorial pages, and I just read one in the Journal the other day about, will the federal government be bailing out blue states and their underwater public pension plans? And now, we asked the same question, a year ago. So I think we were a little bit prescient. And I think there are plenty of things to worry about. But the good news is that we have an incredibly strong economy. We live in the greatest country in the world thus far, and it has managed to survive every shock that has been presented to it. And we believe it is likely to continue to do so, although there are grounds to worry about.
Good stuff. And it sounds like you have enough material for the next 3 books as well there. ready to go. So Alex Pollock and Howard Adler, in the book again is Surprised Again, the COVID Crisis and the New Market Bubble, available pretty much everywhere. Have you guys done an Audible book?
We have not.
Okay.
We have not, no.
Got it. So not available on Audible, but you can read the old-fashioned way. So, okay, guys, thanks so much for joining us, and would love to have you back again in the near future.
And thank you so much for having us. We really enjoyed the conversation.
Great to be with you.
Be right back. Welcome back to the show, everyone. Hope you enjoyed it. Interesting concept, right? Essentially, the idea being that, the government's just constantly kind of looking for opportunities to increase its role and control and stuff like that. Like the guys brought up the whole idea of the central bank, decentralized currencies, things like that, could be the next thing. But, that's a whole nother show altogether, because the question of whether those CBDCs are really intended to, exchange out cash, I doubt that. I think they will be much better at tracking people's behavior and that kind of thing, though. At any rate, I'm sure the government would love to have that. The Internal Revenue Service would love to have that. Anybody who wants to know more about you would love to have that control. But hopefully we'll also have these prevailing forces, counter forces, that can prevent some of these civil liberties from being violated. Anyway, that's it for me this week on Wealth Formula Podcast. This is Buck Joffrey signing off.
Thank you for listening to the Wealth Formula Podcast. Visit us on the web at wealthformula.com. The information contained in this podcast are opinions, not fact. As always, consult your own financial team before making any investment. See you next time.